This is Nebraska Farmcast, a production of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. I'm Ryan Evans. High commodity prices and good yields contributed to a rise in net farm income and improvements in profitability across Nebraska last year for many agricultural operations. Many of those businesses experienced improvements in liquidity, but there could be challenges ahead for them in protecting that. That's according to Tina Barrett, director of Nebraska Farm Business Incorporated, which provides financial analysis, business planning, and tax services to over 400 clients in agriculture across the state. She joins me now to discuss more about what their 2021 data reveals about the financial standing of farms in Nebraska and what that might mean going forward. Hi, Tina. Thanks for joining me.
Yep, happy to be here.
So you have a new article on our website, cap.unl.edu, where you walk through some of this. And just to start, Nebraska Farm Business publishes annual farm business averages for the state. So now that 2021 data is available, how did producers fare in terms of income and profitability?
Yeah, income was at an all-time high. If we index for inflation, then 2011 ends up being a pretty similar year. And so, to have a year like that, twice in 11 years is certainly a great thing. We saw a lot of improvement in balance sheets, especially in liquidity, as we saw a lot of those ratios bounce back, not quite to a 2011, 2012 level, but closer to what we saw in like 2013.
And your new article on our website, as I mentioned, is about protecting that liquidity that came to many businesses that improved their profitability. So what factors into measuring liquidity itself?
Yeah, so when we're talking about liquidity, we're looking, traditionally at three ratios that all have to do with current farm assets and current farm liabilities. And those are, again, those things that are going to sell or convert to cash in the next 12 months, and those things that you have to pay in the next 12 months, like your operating note, current payments on your term notes, accounts payable, those sorts of things. And so we look at how those two work together. So current ratio measures how many times you can pay your current debts with your current assets. Working capital measures how much is going to be left over after you pay those current debts. And then we look at working capital to gross revenue so that we can compare operations of different sizes in how that working capital goes. And so we saw, working capital levels returned a little over 40% at like 42% this year. We'd like to see that number be above 30 or 33, depending on who you talk to, which we haven't seen since 2014, maybe 2015, as it was on its way down after peaking at 50% in 2012. And so, it's a good thing. We're just still not back to where we were after that extended period of profitability 15 to 10 years ago. So.
And you write that starting tax planning before harvest this year is going to be very important in making management plans. Can you explain more about that?
Yeah, I think, we have a lot of producers who do it on a regular basis. I think this year is going to be even more important. First off, with all the carryover grain that was pushed from last year, all the profitability from last year that got pushed into this year with carryover grain, all the extra prepaid, those kinds of things that happened to control last year's tax planning is bigger and has a bigger impact than what we've seen in several years. The other factor for Nebraska, again, as you drive around, it doesn't take much to realize how much crop insurance indemnities there's going to be. Lots of hailstorms, lots of wind. And that's going to add a whole nother layer of tax planning complexity to this year, which we can, under the right circumstances, defer crop insurance, but it's an all or none election, which means we either have to take those large crop insurance checks in this tax year or next tax year. And sometimes that's hard to manage when the payments are as large as many operations are going to see this year. So for several reasons, that tax planning early from an income side is important, and the expense side is just as important. Especially in 2008 to 2012, there was a lot of new equipment purchased. We took advantage of a lot of the depreciation rules. And this year we might not have that opportunity. Equipment is so much harder to find. New equipment is just not as available. And so if you're looking at making equipment purchases, December might be too late to really be able to find one that makes good management sense and helps you with your tax plan.
Great. And what does your data tell you about debt in 2021, and how does that trend with prior years?
Yeah, so debt actually decreased for the first time, and I think in probably as long as I've been watching these numbers, which is great to see. It wasn't huge, but it was a couple 100,000, and certainly significant enough to call a decrease. And that's a great thing, because as we constantly increasing debt, we're constantly increasing risk, and taking these opportunities of profitability to reduce debt is always going to be important. Because when things get tight, it's not going to be when we have extra cash in order to reduce that debt. Unfortunately, there's no way to reduce debt without paying some taxes, because we need to have cash left over after you've paid the expenses and those non-deductible things like family living, income taxes, principal payments. And so, we certainly saw some positive things, and we want to make sure that continues as we move forward in the next couple of years.
And when it comes to taxes, are there other strategies that could help producers protect their liquidity?
Yeah, there's always things that we can, we want to make sure we manage our brackets correctly. We want to make sure that we're not, that we're doing everything we can to minimize taxes over the life of your operation. That doesn't always equate to minimizing taxes this year. And sometimes those decisions of trying to minimize taxes this year at all costs can end up causing your balance sheet all kinds of problems. If you're buying equipment that you don't need just to avoid taxes, you're spending more money than if you just paid the taxes. And again, I know it's a hard concept, and it's hard to send money to the government when you could have a new pickup or a new tractor. But that tractor or pickup is probably going to save you maybe 30 cents, depending on the tax bracket that you're in, on the dollar. And if you send the taxes in, you'd have 70 cents on the dollar to reduce debt. And sometimes that can do a lot more to improving the health of your balance sheet and putting yourself in a position of financial health to withstand, what we know, will be coming in tight margins and some of those rougher years. That just seems to be part of the nature.
All right. Great, helpful information there from Tina Barrett, Director of Nebraska Farm Business Incorporated. Again, you can find a new article about protecting liquidity that Tina has written on our website, cap.unl.edu. Tina, as always, thanks for the great information.
Yep. Thank you.
Nebraska Farmcast is a production of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. For the latest research-based information and education resources to manage your farm or ranch operation, visit our website at cap.unl.edu. That's cap.unl.edu.